So you're welcome back, my dear professional students. In the previous videos, we were able to solve or work out all the necessary points that we need to solve the requirement of this question. And we said the next point or the next thing we need to do is to determine the pre-acquisition reserves. But before we go and do that, let's look at the reserves in the books of the subsidiary. In this question, the only reserve the subsidiary has is a retained earnings. And the retained earnings was 3,900. So let's go and determine the pre-acquisition reserves. So that will be workings what? Which workings did we stop? I think we stopped at working 6, no, working 7. Yeah, working 7. So that means we are moving on to workings 8. So let's move on straight to workings 8. Okay. So workings 8. That is the pre-acquisition retained earnings. Okay, the pre-acquisition retained earnings. So how do we determine it? Usually, you would be given the pre-acquisition retained earnings, which is the retained earnings at the date of acquisition. Usually, you would be given in the question. But because this question is an acquisition during the year, you will not be given because it's an acquisition during the year. We acquire the subsidiary during the year. So one way or the other, you would be required to determine it yourself. Now, this is how you do it. I would advise you to look at it from here. From the question, the year end was 31st October 2014, right? That means the beginning of the year is 1st November 2013, right? And we acquired the subsidiary on 1st May, right? 1st of May 2014. That is an acquisition during the year. So there's 6 months here and there's 6 months before. Now, when we say pre-acquisition reserve, we are talking about the reserve at this date. The reserve at this date, which is 1st May 2014. So there are two ways of doing it. If you know the reserve at this date, just deduct the reserve or the profit from this date to this period. 6 month profit. Deduct it. You will get the reserve at this date. Or if you know the reserve at the beginning of the year, just add this period, this 6 month period, you will get the reserve at this date. Yeah, those are the two periods or two ways you can do it. So the way I will do it is I will use this, then I will deduct this, then I will get the reserve at this date because I was given this in the question free of charge. So that means for me to get my pre-acquisition reserve or retained earnings, I will need my retained earnings at 30th or 31st October, as given in the question, given that is 31st, at 31st October 2014. And that retained earnings was, as we saw, was, this is in millions. It's 3,600. Let's confirm it from the question. The retained earnings of the subsidiary. Okay, it's not 3,600, it's 3,900. Okay, it's 3,900. So let's go back and change it to 3,900. So it's 3,900. Okay, so if I deduct that 6 month profit, okay, you know that this will be the profit for the year. From this, the beginning of the year, to this period is the profit for the year. Yeah, and I'll be given profit for the year. So if I get profit for the year, I can get the 6 month profit. If I deduct it from the retained earnings at this date, I will get the retained earnings at this date, which is what I'm looking for. So, from the question, I'm sure we were given the profit for the year of the subsidiary. Then I will prorate this profit for the year by 6 months. So what's the profit for the year of the subsidiary? I will get that in the statement of profit or loss. Okay, good. 1,800. So 1,800 is the profit for the year of the subsidiary. Get 6-month portion. That will simply be 900. If I deduct this, I will get 3,000, which is the retained earnings. Retained earnings at 1st of May 2014, and that's my pre-acquisition retained earnings. Okay, is that clear? Please, you need to master this. You have to master it. It's very straightforward. Just get used to it. So now, having determined that, so I want to cancel out the purchase consideration against the net asset acquired or the equity of the subsidiary. So, what's the purchase consideration? Sometimes it could be called consideration transfer. Now, the purchase consideration, we determine it in the question. When we were working for the purchase consideration, this is it. And we determine the purchase consideration as 5,760, and we say we'll add it to investment in subsidiary. So this investment in subsidiary is what we call purchase consideration. We want to cancel it out. So let's go and have it as 5,760. So I will have 5,760. Let me have it at this extension here. 5,760. That's the amount paid by the parents. Then I will determine the amount paid by the non-controlling interests, who is the NCI. And we're told that the NCI is measured at fair value, and we have noted the figure up here. NCI at fair value. We noted it as 3,540. So let's go and add it there. 3,500 and what? 540. Yeah, this is my non-controlling interest. That's 3,540. Okay. So he paid 5,760 for 60%, 3,540 for 40%. So that's 100% value. So how much is that? Let's add the two together. 5,760 plus 3,540. That gives me 9,300. Having determined my 9,300, I will cancel it out against the net asset acquired. And this net asset acquired is the share capital of the subsidiary and the reserves of the subsidiary. So I will have here the share capital of the subsidiary. And from the question, we can easily determine the share capital of the subsidiary from the statement of financial position of the subsidiary. Let me clean all of this. You can see some points. Okay. Now, the share capital, which is the equity of the subsidiary, is 2,400. So, I will have here 2,400. Then, the pre-acquisition retained earnings, which we have determined up here, the pre-acquisition retained earnings, which is the retained earnings as of May 2014 was 3,000. So we're going to add it here as 3,000. And there is one other reserve which I don't want you to forget, which is the fair value reserve that arises as a result of fair value adjustment. So where is that fair value reserve? I think it was workings 3. Yeah, workings 4. Fair value reserve. Okay, this fair value reserve of 1,200. Okay, so let's go and add it because we said it to be a pre-acquisition reserve. So fair value reserve of 1,200 of 1,200. So let's add these 3 together. 2,400 plus 3,000 plus 1,200 will give me 6,600. So I'll compare this with the amount paid by the parent and the subsidiary, 9,900. So 9,300 minus 6,600. That gives me 2,700 as my goodwill. So my goodwill is 2,700, and it is a goodwill because the amount paid by the parent and the non-controlling interest was higher than the net assets acquired. So we have determined a goodwill of 2,700. If the net asset acquired of 6,600 was higher, then we'll have had a gain on bargain purchase. Okay, but in this case, it is a goodwill. Now, having determined that, which is workings, this was workings 8, so this is workings 9, so workings 10 will be my consolidated retained earnings. That will be the workings 10. So workings 10, consolidated retained earnings. And the consolidated retained earnings is usually the retained earnings of the parent company and our share in the post-acquisition retained earnings of the subsidiary. Okay, that's the consolidated retained earnings. So that means I will need the retained earnings of unitarization, and also that of famous. So Naira value. So at the date of consolidation, at consolidation date, what was the retained earnings of unitarization and famous? You will get that from the statement of financial position. The retained earnings of unitarization and famous. The retained earnings of unitarization, was 21,240. 21,240, I'm noting it down. Why? That of famous is 3,900. Okay? So let me go back to my workings and insert that figure there. So that of unitarization was 21,240. While that of famous was 3,900. This at the date of consolidation. Then from here, we are going to deduct the pre-acquisition retained earnings of famous, which is the retained earnings at the date of acquisition. So what's the retained earnings of famous at the date of acquisition? We determine that as 3,000. So let's go and deduct it from the retained earnings at acquisition. So this 3,000. So the post-acquisition retained earnings is 900. So from this post-acquisition retained earnings, we're going to adjust for consolidation adjustments that arise during the period. which are the periods after acquisition. So let's go to our workings now, from workings 1, and see if there is any item that would have affected the retained earnings of either the parent or the subsidiary. The additional information 1 was really on group structure, so it won't have any effects. Then the date of acquisition and the date of consolidation. Then NCI, then fair value adjustments. Now, the fair value adjustments will affect. The only effect is the additional depreciation that we got as 120 million. And remember, we said we will deduct it from retained earnings of Famous. Okay? Retained earnings of Famous. So let's go and deduct the 120 million from the retained earnings of Famous. So there is an additional depreciation. There is an additional depreciation of 120 million. Okay? So let's go back to our workings. After we have deducted the additional depreciation from the retained earnings of Famous, as given here, then we want to look at other additional information. Purchase consideration will not have any effect. Okay, intragroup sales of goods should have effects on the retained earnings in the statement of financial position. So the unrealized profit. So we had an unrealized profit of 480 million here, and which we said we are going to deduct from the retained earnings of Famous. So let's go and deduct the unrealized profit of 480 million. So we have unrealized profit of 480 million. So back to our workings. What is remaining there is just that intra-group sales where we have to delete trade receivables, trade payables and all. So that will not affect the retained earnings. So that's it. So let's go back. So now, so let's get the net figure. So bring out your calculator, which will be 900 minus 120 minus 480. That will give 300 million. So we're going to have a net amount of 300 million. So now this 300 million, it will be shared between the parent entity and the non-controlling interest. So let's have this group share. And that will be 60% multiplied by 300 million. So press your calculator. What will it give you? That gives me 180. If I add 180 to 21,240, that will give me 21,420. 21,420. And that is my consolidated retained earnings. It's simply the retained earnings of the parent plus our share in the post-acquisition retained earnings of the subsidiary. So finally, is the non-controlling interest. And that will be workings 11. And that will be the non-controlling interest. So what is the value of NCI at acquisition? We can easily get it from our Goodwill figure. the NCI at acquisition, okay, which is this 3,540. 3,540. So we'll add his share of post-acquisition retained earnings. His share of post-acquisition retained earnings. And which will be 40%. And the post-acquisition retained earnings as determined up here was 300 million. Okay. So multiply 40% by 300. So what would that give us? 0.4 times 300. That gives me 120. So if I add 120 to 3,540, that gives me 3,660. And that is my non-controlling interest at the date of consolidation. So what I have now is for me to start preparing my statements, which I will start doing from the next video. So thank you very much, guys. See you in the next video.